and welcome to HAVE.crypto's YouTube channel, where you can find and learn everything about crypto markets and trading. In today's lesson, we will learn about moving averages. So, take a comfortable seat and let's get started. In technical analysis, the moving average is an indicator used to represent the average closing price of the market over a specified period of time. Traders often make use of moving averages as it can be a good indication of current market momentum. The two most commonly used moving averages are the simple moving average, SMA, and the exponential moving average, EMA. The difference between these moving averages is that the simple moving average does not give any weighting to the averages in the dataset, whereas the exponential moving average will give more weighting to current prices. The simple moving average, SMA, is a straightforward technical indicator that is obtained by summing the recent data points in a given set and dividing the total by the number of time periods. Traders use the SMA indicator to generate signals on when to enter or exit a market. An SMA is backward-looking as it relies on the past price data for a given period. It can be computed for different types of prices: high, low, open, and close. In financial markets, analysts and investors use the SMA indicator to determine buy and sell signals for assets. The SMA helps to identify support and resistance prices to obtain signals on where to enter or exit a trade. The other type of moving average is the exponential moving average, EMA, which gives more weight to the most recent price points to make sure it's more responsive to recent data points. An exponential moving average tends to be more responsive to recent price changes, as compared to the simple moving average, which applies equal weight to all price changes in the given period. Before moving forward, make sure to like the video, subscribe to our channel, and click on the notification bell. It's free. How do we interpret moving averages? There are three ways in which traders use the moving average. To determine the direction of the trend. When prices are trending higher, the moving average will adjust by also moving higher to reflect the increasing prices. This could be interpreted as a bullish signal, where traders may prefer buying opportunities. The opposite would be true if the price was consistently trading below the moving average indicator, whereas traders would then prefer selling opportunities due to the market signaling a downward trend. To determine support and resistance levels. The moving average can be used to determine support and resistance levels once a trader has placed a trade. If the trader sees the moving average trending higher, they may enter the market on a retest of the moving average. Likewise, if the trader is already long in an uptrend market, then the moving average can be used as a stop-loss level. The opposite is true for downtrends. The charts below are examples of how the moving average can be used as a both support and a resistance level. Using multiple moving averages for long and short-term market trends. It is common for traders to make use of multiple moving average indicators on a single chart, as depicted in the chart below. This allows traders to simultaneously assess the short and long-term trends in the market. As price crosses above or below these plotted levels on the graph, it can be interpreted as either strength or weakness for a specific currency pair. This method of using more than one indicator can be extremely useful in trending markets and is similar to using the MACD oscillator. When making use of multiple moving averages, many traders will look to see when the lines will cross. This phenomenon is referred to as the golden cross, when a bullish pattern is formed, and the death cross when the pattern is bearish. A golden cross is identified when the short-term moving average, such as the 50-day moving average, crosses above the long-term moving average, such as the 200-day moving average, while the death cross represents the short-term moving average crossing below the long-term moving average. Traders that are long should view a death cross as a time to consider closing the trade, while those in short trades should view the golden cross as a signal to close out the trade. Thank you for watching our video. Next time, we will review some of the most reliable trading indicators. Also, don't forget to check out HAVE.crypto.io and try our trading indicator. Subscribe and don't miss this opportunity.